Anything else that's of note in regards to just where insurance rates are coming in? And do you see that becoming a less stressful dynamic as it relates to putting deals together?
I would say it's all deal by deal basis. It's still really tough right now for anything pre 1980s. And that's kind of coming into more carriers coming into the market now in Florida. We're starting to open up capacity to the 1980s built product, but it also depends on location.
What's going on, everybody? Welcome back to another great episode here on the Multifamily Wealth Podcast. In this episode, I'm chatting with a friend of mine, Mark Savarase, who is a top multifamily broker in the state of Florida, primarily covering kind of the west coast of Florida, St. Pete, Tampa, all the way over into Central Florida to the Orlando, kind of south of Orlando area. Mark is someone who I've worked on a handful of deals with in the past and brokers a lot of small to, or I should say, mid-sized to large multifamily deals. He really specializes in the 30 to 99 unit range. And as someone who's been a full-time broker for 7 years now, has done a whole slew of transactions and works with one of the most accomplished brokerage firms in Florida called Franklin Street. And in this episode, we dive into what makes a buyer a good buyer and a buyer that a broker wants to work with. So we get into all of the things that you can do as a multifamily buyer who's working with brokers and submitting offers to brokers in regards to how you can stand out, how you can build better relationships with brokers, and ideally, how you can win more deals. We also get into the current state of the Florida real estate market and really compare and contrast what the market from 2018 to 2022 was like versus the last few years and really the last kind of 6 months post-election in terms of getting into the real current events in regard to what's going on within Florida from a real estate standpoint. And we also touch on more national commentary there as well in terms of differences in the standard offer that buyers are making, just the competitiveness of buyers, talk about supply, and we also talk about how you can build a brokerage business. As part of that conversation, we spend a lot of time talking about just generally speaking, how you build a business as a broker, as an investor or a principal, as a lender. So a lot of just really valuable topics of conversation here. And specifically, if you're someone who's investing in the Southeast or Florida, we're really going to get into some content that I think is helpful for you as well. But be sure to listen to this episode, even if you're not a Florida investor. Maybe you skip past the first 10, 15 minutes, and then we get into topics that are a little bit more relevant to you, although I still suggest you listen to the whole episode regardless. But again, great episode with Mark Savarese here. If you haven't already, please leave the podcast a rating and review. Helps the show get noticed by more folks, which is our goal here with the Multifamily Wealth Podcast, is to help more multifamily investors start, build, and scale their businesses, and reviews help us accomplish that goal. That said, let's get to this episode with Mark Savarese. All right, Mark, how we doing? Welcome to the show. Pleasure to have you. And I think this is going to be a fun one because I don't oftentimes have too many folks on the podcast who I've like actively worked with from like a service provider standpoint, whether it's on the brokerage side or the lender side or what have you. So I think this will be a fun one, both for you and I, because we've known each other for a bit, as well as a valuable one for the audience. But before we actually get into, the content of this episode, let's start with your background. What were you doing kind of pre-real estate? Maybe how you found the business and what are you working on today?
Yeah, so appreciate you having me on. It's one of my first podcasts, so should be interesting. I'm excited. But yeah, so I mean, my background, I came pretty much straight out of playing professional baseball. Went to USF, got a degree in marketing, and then while I was at USF, I had another year to play. So decided to do a master's in entrepreneurship. Didn't really know what I wanted to do, but was always kind of academically inclined as kind of my downfall to being a short right-handed pitcher. So made it as a free agent with the Tigers. Got released after one season and turned down a minor league contract with the Red Sox. Figured at that time I was 22, 23 years old, and there's a lot of 16, 17-year-old Dominican, Venezuelans, and then a lot of American players that were much better than me. And so younger, better, I understood the business of minor league baseball. So figured I'd hang it up relatively quick, but was able to get a free master's, relatively free master's at USF, and didn't really know what I wanted to do. So reached out to my brother-in-law, who at the time in Orlando was working for Cushman and Wakefield as a office leasing broker. Basically told me, do whatever you can to get into commercial real estate, whatever avenue you want. So reached out to a few different firms and figured multifamily, why not? Seems like an interesting asset line. Didn't really know anything about multifamily at all, didn't know anything about commercial real estate at all, didn't know what a cap rate was. So, kind of went in there full training and figured it out relatively quick. I mean, it's not rocket science. I think most people can figure it out pretty quickly. And, the kind of excited career that I built.
And when was this in terms of when you left baseball and when you got into the real estate business?
So 2018 is when I got released and got into the business. So kind of jumped in full force, so it was exciting to do.
Yeah. It's funny you got a contract offer from the Red Sox. That's close to home for me here, but
I've been down in Fort Myers, so would have
yeah.
been in rookie ball in the tough Florida heat, which would have sucked. So I was like, you know what, let's do something a little better.
What was your best pitch? What was your go-to pitch?
It was my cutter. My cutter was my
Yeah.
go-to because when I got to pro ball, anytime I threw a fastball, it was hit either 1,000 miles or 1,000 miles foul. So I was like, let me start throwing a two-seam fastball on a cutter and see what that does. And had some success with it. Just unfortunately didn't throw hard enough for the Red Tigers. So it was a short career, but it was
I
fun.
hear you. Now, the a friend of mine played a very similar story. 1 year professionally out of college, and then he did the minor league jumping around, triple A ball, double A ball before I think he was in his mid 20s, probably 25, before he was like they had the same arrived at the
Yeah.
same conclusion you did, right? And he's like, okay, uh, there's some cats coming out of college or out of country that are just slinging it. So this is maybe not my game, and I'm not going to break through in my mid 20s. So, anyways, yeah, that's I think it's a really relatable story in baseball, but nevertheless, we'll get into real estate here. So, 2018, you joined Cushwake. Learning the business, jump into the brokerage side. Obviously, I want to talk about Florida, right? Because you cover Southwest Florida, over into, kind of Central Florida, heading south of Orlando along I-4. And, I'll let you kind of maybe share exactly what you're working on right now from a market deal type standpoint. But at a high level, I want to talk about just because I think this will be applicable almost nationwide. I think this is the trends nationally from a real estate standpoint from 2018 to 25, which is when we're recording this over the last 7 years, have been more or less consistent. Whereas, over the last few years, there have been some pockets of the country, maybe Florida falls into this camp that have been hit a little bit differently with some insurance stuff, rising interest rates, et cetera. But that said, broadly speaking, macroeconomic over the last 7 years, I feel like it's been more or less kind of similar throughout the country. Those deals that you were doing in 2018, 2019, maybe 2020, maybe into 21, and I'll let you kind of frame the timeline of when you would broker a deal, when you'd sign up a listing agreement, when you take a deal out to market, just generally the what would need to be done on the buyer side, or what you would expect to see on the buyer side from an offer standpoint or a competitive standpoint, whether it's terms, price, et cetera. Compare and contrast that over that period of time, and maybe you pick out like a point in time that's a little bit more relevant in terms of using it as an example versus now, that give people like a really broad sense of how things have changed since you've been brokering deals and in the business. And I think that's probably going to be like the pre-COVID, last 12 months, 24 months time frame. But in terms of what you've seen as it relates to like the standard terms being offered by a buyer, the standard competitiveness of a contract when you're actually listing a deal, maybe some commentary on how often deals are being retraded now comparatively to back then. That way, people have a conceptual understanding of, okay, this is kind of broadly what the real estate market's done over the last few years and how it's changed, and then we'll dive into maybe the specifics of like a Florida.
Yeah. So when I first started, it was 2018. I mean, we were a team of four producers, so we were doing, let's say, 20 to 30 deals a year between the four of us. And it was, pretty straightforward at that time, pre-COVID. I would say, you put a deal out to market, you have in 30 days, 7 to 10 competitive offers, all kind of, within that, I would say within 10% of your list price. Normal terms, you'd have, I would say, kind of 3 to 5% deposit, anywhere from 15 to 30-day due diligence period. Some would have financing contingencies. If you were competitive, most wouldn't. And then you were a standard 60-day close. And that was pretty much the norm.
Deal
Then we
goes
got
to the
to,
person with the best track record who's also offering similar terms. Yeah.
yeah. And to be honest, a lot of the times we were dealing with, repeat clients, guys that we've sold deals with before. So we were very confident that the whole no retrade type of environment. And, we would kind of vouch for a couple of good clients that we've sold deals to in the past. And that was really the history of the market pre-COVID. And then COVID came, and then it was just pure chaos in Florida. I mean, everybody was moving down here. Everybody wanted to buy down here, especially in that Tampa market. Tampa got extremely, extremely hot. I mean, the heat of 2021, we would list a deal, and within the first day, we'd have 20 offers over ask, and then we would have to try to do a best and final with those offers. And a lot of them would be hard money day one. So it got extremely competitive and very difficult to buy, especially if you were new to market because you weren't getting the time of day. Unless you were pretty seasoned and had a good conversation with a broker on the phone, and you were buying a deal in a more tertiary market outside of Tampa, you maybe would get a shot. And if you did get a shot, you'd have to perform. Otherwise, you'd be basically blackballed. So it got extremely competitive. And that was up through, I would say, like April of 22. And then from there, once interest rates started increasing on us, we basically deal volume shut off. So 23, we did 6 deals between the four of us. Last year, we did 8. Transaction volume completely fell off a cliff
Do you
once
remember what it was
interest
like 21 time frame, like in terms of
that was
number?
2022. April of 22 is when interest rates started increasing on us.
Mhm.
We got some deals across the finish line throughout 2022. And then second 2023 came around, we were just completely dead. I mean, nothing was going on. People were obviously having issues because everybody was buying with floating rate bridge debt at just dirt cheap prices. I mean, I sold a deal at like a 2.5 cap, true 2.5 cap with adjusted taxes, insurance at that time, and it was a good deal. And it's just pure chaos in the market. So now we're starting to see things pick back up. I think there's a lot of different factors. And me, I kind of head up the 30 to 99 unit space over through central west coast of Florida. And then I have 2 senior partners that do 100 plus units throughout the state. But right now, I mean, we're definitely seeing more optimism in the market. I mean, I do think the tariffs kind of, put a dent in that, and you're seeing a lot of volatility in the treasuries, which have affected us. But we are overall, I would say, we're seeing some more optimism, and I think there's a lot of different factors playing into it. In the smaller space, there's always motivation to sell. There's divorce, partnership disputes, death, whatever it may be. The larger space, obviously not so much. So that 100 plus unit space has really been turned off the last 2 to 3 years. And we're starting to see some movement in those. We closed 194 unit over on the East Coast earlier this year. And have a couple deals that we're going to send out over 200 plus units. So we're seeing, starting to see good activity from there. And I think a lot of it is just deal fatigue. I think a lot of these groups are just at the point where they're trying to keep these deals alive and trying to cash flow deals that just don't make sense. And I think at this point, they're just saying, let's just get this off our books, break even, take a small loss, move on. We're starting to get to a new market where that bid-ask spread between buyer and seller is starting to tighten up. So I think overall, I think the market's in a good position. And Q3, Q4, I think is going to be pretty solid for us.
Yeah, I think that's probably a dynamic that's prevalent throughout many of the markets in the country, and I know it is in New England where we do the vast majority of our deals. Obviously we've done some stuff in Florida together. We were the textbook definition of the buyer that hit pause in 23 and 24 because we weren't local and therefore didn't really have the confidence in our ability to underwrite a deal and really execute that business plan like with an in-house management company because we work with third party to feel like we could confidently pursue deals, make offers, and if we actually, I think if we would have made an offer and won a deal, we'd be like pretty nervous versus excited, which is not really a situation that you want to be in as a buyer, especially if you're raising investor capital to fund the deal. So, we were part of the folks that had paused, but now I think that there's almost an element of acceptance, one, around rates just being where they are. And I think that's probably a nationwide dynamic where, 23, maybe are they going to come back down in 24? I think a lot of people still had optimism at that point in time that maybe we were going to look at these interest rates for 12 months, 18 months. Halfway through 24, it's like, okay, we've been at this level for a couple of years now. Not really, there's really no quote unquote end in sight as it relates to the end of being a 10-year treasury that's coming down or whatever your benchmark rate is coming down depending on your lender, into 25. We're now into late April of 2025. Rates still haven't really materially moved. So I think people are like, this is kind of the rate that, or the interest rate environment that we're operating in. There's some level of acceptance there. There's probably some level of acceptance with sellers who are now 2.5 years into a deal that maybe they aren't that enthusiastic about, and they're trying to figure out, as you just mentioned, and understanding that, okay, it's not like in the next 6 to 12 months we have this clear event or indicator that's going to help us from a tailwind standpoint and just market values or compressing cap rates or interest rates that falls. Maybe now is where we just kind of lick our chops and we just sell, just or lick our wounds rather, and just sell. I know that's a dynamic in New England, and seems as if it's a dynamic in Florida as well. Big thing with Florida and many markets throughout the country, but specifically Florida, that is a nationwide talking point, is insurance. I know you're not an insurance guy, but you sit in the middle of a lot of these deals where you're looking at the quotes, whether you're listing a property and trying to put together a package to show to your list of buyers when you're working with a seller, or you're working on the buy side, you're asking, or you're working with a buyer client and they're finding out what insurance they're getting. Over the last couple of years, how have you seen that trending? Is the insurance market getting any better? Do you see anything else that's of note in regards to just where insurance rates are coming in? And do you see that becoming a less stressful dynamic as it relates to putting deals together?
I would say it's all deal by deal basis. It's still really tough right now for anything pre 1980s. And that's kind of coming into more carriers coming into the market now in Florida. We're starting to open up capacity to the 1980s built product, but it also depends on location. So like the barrier islands, really, really challenging to get insurance. Just to get insurance, most of the time we're just getting denied.
Mm.
I'm working on a deal right now, and we're going through that issue, and I'm hoping we're going to get through it, and I think we will. But it's going to be expensive, and it's just kind of what it is. I mean, carriers kind of pick and choose, and they have the luxury to do that. So if you're more inland, we're actually starting to see decreases of 10 to 15% from the significant increases that we did see over the last 2 years. I mean, we had some groups seeing 50+% increases year over from 2022. So it's definitely a serious matter, and it's starting to get under control. And I think it's just because it's getting more competitive in terms of carriers entering the market. So it's going to take time, but definitely on anything, I would say 80s and newer, you're seeing much more competitive rates than what you're seeing on anything 70s and older, especially if it's 20s build. 20s build, it's very difficult, but we're working through it for the most part. And as long as you're not coastal being, within a mile from saltwater, usually your insurance is actually pretty decent. And when I say pretty decent, you're in the 12 to 1500 a unit range, which still seems extremely high. I think when I came into the market, I think we were at like 600 a unit, which I thought was high at that point.
It always feels high because
Yeah.
it's one of those things where whether you're a broker and you're trying to get the best price for your client, or you're an investor that's trying to maximize cash flow and therefore value, it's like any increase you kind of balk at, especially insurance where you so rarely use it. Although last couple of years with all the storms, I think people are using it more often than at least when we started looking in Florida, which is like back kind of 2020, late 2019 range. And I'll just speak anecdotally for our deal in Central Florida, the last building that we own, where our 23 to 24 rate was much higher than our 24 to 25, and we just did our 25 to 26 renewal. And it, not massive cuts, but like 5 to 7% decreases year over year in terms of our just base premium for just building coverage, wind coverage.
Mhm.
So some relief, still per unit much higher than where we would like to be and where we were when we closed the deal back in early 2022. But we're trending in a better direction. And that's just speaking as in where Central Florida, we're not by the coast, right? I think there's more carriers, there's less volatility, as you just mentioned.
Yep.
Yeah, I can't imagine, like for example, like folks that own stuff in Sarasota where there's been like 3 floods over the last like 3 years, it seems like, in terms of a lot of carriers going through some heavy losses there.
Mhm.
And a lot of them just leaving the market. Other dynamic in Florida, as well as many parts of the country, Texas, Arizona, Southeast, Southwest US, not as big of a dynamic in the Northeast or the Midwest or like the Mountain West, but is still somewhat of a dynamic in that a lot of supply is being added to the market, right? Varying levels depending on the market you're in. Florida's been a market where there has been a lot of new development over the last few years, something that we've contended with in terms of we're competing with a few new buildings. We've had to adjust our rents accordingly to get our units leased, get them filled. I'm sure that's a dynamic in terms of how you've been, you're looking at rents for sellers. You're familiar with the marketplace in terms of where rents have trended and what you're modeling when you take a deal out and all of that. Just high level commentary on supply and maybe where rents are right now as it relates to what they've done the last couple of years, and on a go forward basis, I don't know if, for example, Franklin Street or your team puts together some type of analysis on a go forward basis, like, yeah, we've had a lot of supply. It's coming, we're going to have significantly less new supply or new development over the next 12. What's your feel on supply, just kind of general commentary in the markets that you cover right now and how it's affecting rents?
Yeah, I mean, we haven't put anything together on it, but I've seen some slides on how much we've built as in Florida. 2022 was one of the most active years of building development that Florida's ever went through. So a ton of new supplies is hitting the market or has hit the market in 2023 through now. So it's created a huge issue. And a lot of those new construction bills are offering 2 to 3 months free. So it makes it extremely challenging for the B and C class space as well to try to compete with that. I was dealing with a property in Central Florida. It was a nice 1985 built concrete block, and it had a decent amenity set because it was conceived as condos when it was built. So it had, his and her saunas in the clubhouse. It had a pool. It had a nice gym, nice little clubhouse area, and then it had tennis courts as well. But they just couldn't hit the rents that they were trying to hit because three new apartment complexes were built that were offering 3 months free. So how do you compete with that? You have to lower rents, and that's what we've been seeing. We've been seeing kind of that either steady rents depending on what market you're in, or we're seeing a slow decline or have seen a slow decline. But good news is a lot of that new supply is hitting the market and being absorbed. So I think in the future, hopefully Q3, probably Q4, Q1 next year, I think you're going to see a lot of that new supply being absorbed. And then there's really nothing to follow that because we didn't build in Florida. We didn't build much and didn't break ground on much in 2024. Not a lot of new supply is going to come on market and to backfill that. So I think you're going to see organic rents continue to grow in that Florida market. And you're still seeing population growth here.
Yeah, I mean I think that's the interesting dynamic too, is like, yeah, there's been a lot of supply, right? They built a lot to meet the mass influx of new residents from COVID, right? 2020 to now, right? There was that spike in 2020, 21, 22. People have been moving around a little bit less the last few couple of years, but there's still positive net migration to Florida, right? It's not like people haven't continued to move to Florida or really the Southeast US in general. And if supply is going to fall off, that doesn't mean that there's still not structural demand for all of the apartments that are here, regardless of whether an 80s build or a bill in the last 3 years type of products. It seems as if that's going to continue to become a little bit better for existing operators who are looking to lease, trade. Positive lease trade outs is something that we haven't seen in a while, I think, in Florida, right? At least a couple of years where now if a tenant moves out, we may be able to bump at least a few percent on their last lease, depending on where they were at. And I think that's going to be a much more favorable environment, I think, for transaction volume, would be my guess, because you have more buyers that are interested. There's going to become more buyer demand because it feels a little bit easier to model out rents. And I think that's a hard part of being a multifamily buyer investor, someone who's taking down deals and executing value add plans. It's like, if you aren't confident in your projected rents, you have to be such a conservative buyer and you have to make such conservative offers that it really hurts transaction volume because there's not a lot of aggressiveness in the marketplace, which makes it harder for sellers to get on board with selling, right? And therefore it impacts pricing. Which at least from afar, you're way more in it than I am, but it seems like that's been a bit of a dynamic in Florida. There's a lot of the people that are just don't know how to underwrite on the rental side, on the rent rates that they're going to achieve, which makes them less competitive.
Yeah, it's just so hard. There's just so many unknowns. And so it's created such a huge challenge for buyers to underwrite deals. I mean, even for us, like when we underwrite deals, it's really difficult to build in a pro forma rent where you think you can actually push rents to, because you're not seeing the positive lease trade outs.
All right, so we're gonna move away from Florida here because I think there's probably folks listening who are intrigued by what's going on in Florida, but also are like, I don't buy in Florida. Let's talk about something else. I want to learn how to get more deals and all that fun stuff and build relationships with brokers more effectively. Very specific question for you. So when you're a broker and you sign up a deal, you take it out to market, and you're collecting offers from buyers. Obviously, we all understand that a buyer with less, or I should say, more seller-friendly terms is going to be a more competitive buyer, right? A shorter DD period, maybe fewer contingencies, shorter closing timeline, non-refundable language around earnest money deposits. So we know that that's true. But What I want to talk about is what you see the best buyers doing that you work with. Maybe these are repeat buyers, maybe these are new relationship buyers in regards to how they work through the presentation of an offer. And actually, let's narrow it down to like a new buyer. Let's say it's somebody that you haven't worked with before, which I think is a lot of the folks who are listening is they haven't done a deal with this broker. They see this deal. They want to put their best foot forward in addition to structuring their offer in a way that allows them to be competitive, price terms, etc. How can they actually work through the presentation of that offer, whether it's including, other documents along with the offer outside of just a purchase and sale or an LOI or what have you, whatever they're delivering, how they can communicate to you as the broker in a way that allows you to have some confidence in their ability to execute. So generally speaking, what are some tips you'd have for buyers who are looking to more effectively present offers and more effectively able to present themselves as buyers and capable buyers?
Yeah, it's a good question because I mean we're starting to deal with new buyers to the market. We're almost seeing a new wave of buyers coming in from multiple different markets. It's almost like an interview process, right? Like we're interviewing them. What do you own? Do you own? What markets? So it's good to have a company overview. It's good to know or show what you own, what you've owned, what you've sold, what other markets you've invested in, if you've invested as an LP or a GP, or you're just buying deals yourself. So those are all questions that we're going to ask. So it's good to, if you do have that, you do have a company background, it's always good to send that in. And then to be honest, like before I even get to LOI, I'm usually digging through a new buyer's underwriting just to see how they're penciling the deal, if they're underwriting taxes correctly, if they have a real grip on reality of where insurance is today. I mean, because somebody sends me an offer and has 600 a unit and insurance expectation, like, I'm going to have that conversation with them and say, hey, like this isn't realistic. Like, let's go back to the drawing board. So I do think that that plays a big role in it. But I would say if you're new to the market, and you've owned, or maybe you don't own, but you know what you're talking about, and being able to speak the lingo to a broker, I think speaks volumes. And brokers in this market where transaction volume is not high, they're going to take a risk on you. They're going to take a shot and just perform. I mean, that's what it's all about. And if you want to be a serious buyer in a serious market moving forward, you have to perform if you get awarded a deal.
Mm-hmm. Now, yeah, it's interesting that you're digging into their underwriting because it's true. It's like, okay, hey, this price works, but when you get your insurance quote back, are we going to be retrading in 2, 3, 4 weeks, whatever it is, right? And that's the
Right.
last thing that you want to be doing with your seller. And I think it's important for buyers to realize, like, the last thing you want to do as a broker is have to go back to your seller and be like, their debt came in at a higher rate than what they underwrote, therefore they're looking for X, Y, and Z. And it's like,
Mhm.
that's never a fun conversation to have. And it's better to just lead with, I think, an offer that is grounded in much more conservative underwriting to reduce the chances of having to have those conversations after the fact,
Right.
or post offer acceptance. I know we kind of touched on this early in our conversation here in regards to kind of the differences in maybe just like standard terms back when the market was really hot, 2021 versus now. But and I know this is a really hard question to answer. I'm basically having you generalize what oftentimes is a very deal by deal discussion, but like median terms that you see on offers now, like compared to when the market was hotter and kind of the difference between the two. For example, I know that back in 21, like vast majority of the offers that were being submitted on deals, like no financing contingency, right? Like we're not going to take an offer with a financing contingency. We've got a dozen of them that don't. If you are including one, it's like your offer is really not that competitive.
Mhm.
Now I think that's a little bit different. Obviously, there's more contingencies in regards to whether it's financing, maybe slightly longer DD. I don't know. You'll tell me. Are probably a little bit more accepted. What do you kind of see as like a typical contract outline in terms of contingencies and maybe how that differs on deals that you're actually taking out to market now? Let's call it just like a, middle of the fairway type of value add deal.
Yeah, I mean, the market's definitely changed. So we're seeing from a due diligence standpoint, I would say you're seeing majority of the time, 21 to 30 days. Um, I would say about half of the buyers that do submit have financing contingencies, 45 days typically. And then it's usually a 60-day close with an extension to closing. So 30-day optional extension to closing with non-refundable deposit for a total of 90 days. That is extremely standard, I would say, in the market today, and it's being well received. I think getting an offer on a property today is just a win. Getting to contract is one thing. Getting a contract to a closing table is extremely difficult. we're starting to see them maneuver through a little bit more. And a lot of that is kind of like what we talked about is the legwork up front. We get debt quotes on every single deal that we take out. We get insurance quotes on every single deal that we take out, and I present it to every single buyer to make sure that they're underwriting properly. They're underwriting to the right debt. They're underwriting to the right insurance. And most of the time, I get multiple quotes. Like Franklin Street, we're full service commercial real estate shop, so we do have insurance brokers, and we do have a capital markets team, which is helpful. But we will go outside of Franklin Street to get multiple different options, just to see. And sometimes they are more competitive from an insurance side on like the smaller deals. And sometimes on capital, if we go direct to the lender, I was working on a deal in up in Spring Hill, and they gave us great terms. So the buyer ended up moving forward with that lender. So it's just you got to be resourceful, and that's kind of why we're here. And the value that we bring is, we just try to spoon feed every buyer in today's market specifically to make sure that the offers that we get are real and the offers that we get are going to go through with minimal headache through the contract period.
Are you spending any more time now digging into who a buyer's lender is going to be than you did previously in terms of, for example, like Fannie and Freddie have become more challenging to work with over the last year and a half. I forget when all that craziness went down with like Meridian there, where Fannie and Freddie started to get a little bit more diligent about digging into who their actual borrowers and getting through the mortgage broker that was bringing them borrowers. In terms of if that has an impact on deals that you're taking out, like are you more or less confident if a buyer's working with a specific type of lender, or has that not really changed too much for you?
I mean, I think it's deal by deal. Like if it's a sponsor that's never transacted before, I'm a little worried if they're trying to go agency.
Yep.
So I'll probably lean them towards going bank or credit union, and hopefully they have a good balance sheet. From a liquidity standpoint, which is usually a lot easier than going agency. But if it's somebody who's transacted before, or they do own in other markets, I feel a little bit more comfortable. But I want to be heavily involved as much as I can be.
Yeah, 100%. In terms of, I mean, let's just talk about, brokers who may be listening to this podcast, right? I think there's a lot of folks that listen to the show who are like, younger brokers who are trying to break into the business and maybe better develop their list of clients, better prospect to potential sellers who that they can build relationships with. If we rewind back to 2018, 2019, early days for you, it's obviously a grind for any broker to get those first handful of listings and to start building that momentum. Do you have any tips as it relates to whether it's strategies to build a book of business or areas of focus for brokers out there who are looking to break in and start brokering multifamily real estate or commercial real estate?
Yeah, I mean, so first off, I was fortunate enough to have great mentorship with Franklin Street. So they had a great training platform, which kind of got me ready. But I think from there, after that 12 to 18 months of training, you're ready to go. You're ready to start making calls to owners. It's a long game. It's not a quick get rich and get out type of thing. And you see a lot of different brokers get in and out quickly because they're trying to make a quick buck. My thought process on it, which may be different than others, is I want to build a long-term relationship with whoever I'm working with. And I want to build a friendly relationship. Like for you, example, like I think I would consider you a friend of mine. And that's what I want to do. And I want to build that. It's just a long-term working relationship. I know you're going to buy deals in the future. And maybe I'll invest in some deals, some other deals with you, or in different markets and whatnot. So that's what I try to focus on. And I think that's helped me a lot. And I try to be an advisor, and I'll tell people, straight up. I told a guy yesterday, he asked me for a valuation. I did a valuation on this property. I told him, listen, if you're not in trouble on this deal, it's not the right time to sell. Let's wait. I can update this valuation every single quarter for you if you want. It's, no harm, no foul to me. Like eventually I think that's going to sit well with him, and eventually he will list it with me. If he doesn't, so be it, but that's what I try to do. And I try to advise. I don't try to, I don't see dollar signs and that's it. I see people for people. I think brokers that are in and out quickly, they just see people as dollar signs. And I think, from a principal aspect too, I think, I don't know, you tell me, would you probably look at me more as a friend as well than, just somebody who's going to bring you deals?
100%. Yeah. And I think, one, that's exactly how I view our relationship. And I think two, It's not too different on the principal side, right? Where, for example, when you're building a relationship with a potential LP, right? It takes a lot of work to get that first deal done. Maybe, if you're a broker, get that first property sold for your seller client. If you're a principal, it takes a lot of work to get that first 50K, 100K check across the door in terms of raising capital from an LP. A lot of that work is front loaded, and then after that, it gets a lot easier, right? The second deal, the second investment, the second whatever, partnership, if you're working with like a JV partner, whatever it is much, much easier than the first one, right? It's like getting a plane off the ground. Like it takes, you burn half your fuel getting the plane off the runway, and then it gets a lot easier once you're in the sky. I think for new brokers, I mean, and I can only imagine how many you saw that got into it in like 2020, 2021 that are no longer in the business. It's probably like double digits for you, right? Especially in a hot market like Florida. For me, it's the same thing on the principal side of the investors who are trying to either A, buy their own deals or B, syndicate deals. A lot of one deal, two deal out of the business or, no deals, right? There's all kinds of momentum. They're trying to build momentum to get a deal done. They don't do it. And I think one, there's the challenge of misaligned expectations as it relates to how quickly a lot of this stuff happens. Like you and I both know, in respects to each of our individual businesses, it takes a while to use the plane analogy, to get the plane off the ground. But once you've developed a few really great relationships, the repeat business comes really, really easily. And if you start executing and doing a good job, it's much easier to do, deals 2 through 5 than the first one. So it's the same thing, I think, in our business being the principal business of raising the money and getting the deals closed. And then I would imagine it's the same on your end where you do a good job listing a seller's property. It's like it's not that hard for them to give you the next one. I'm sure you've had plenty of conversations where it's like deal two is like, hey, Mark, what do you think it's worth? Send me your number. Yep, cool. Sounds good. Let's sign it up. Let's get it sold.
Right.
And there's no sit down lunch meeting of why you're compelling to work with. And, you don't have to go through 25 cold calls, 100 cold calls to even get that proposal out to them in the first place to build that relationship. So,
That's the thing too, is people want to work with people that they like. I think that's
100%.
big too. And fortunately, I'm to the point in my career where I can pick and choose who I want to work with, who I don't want to work with. But getting started, I would say in the brokerage business, it takes a solid 3 years to really start making money in this business. So if you're in it to make quick money, it's not going to happen. And that's why you see a lot of guys get in and out. They may pop one or two deals and then they're done because they realize that it's just they're not going to make money as fast as they want to. So if you're serious about brokerage, it's going to take you a solid 3 years to build that client base. And then once you do build that client base, it's the repeat deals are a lot easier with repeat clients. Like you said, it's more so of me just showing them, hey, this is what the property's worth, and giving them full pitch on why Franklin Street, we've done this and this and this. So really, in my opinion, it really helps to value people as they are and really try to build long-term relationships moving forward, because I think that's going to help. And then obviously, if you have a team too, you can leverage, as a new broker in the business, you leverage deals that you have on market, right? And that's what my mentor always told me. My senior partner, he always told me like, hey, tell people that you have this listing. I know it's my listing, but tell them that I listed this deal in this area, call those owners, and then try to get more listings that way. And business begets business. And that's kind of how it snowballs, and you build your career that way. So if you do have a team, leverage that team, use them. If you don't, you're trying to build it yourself. It's going to be a lot harder, but you're going to do a lot of dead BOVs that are just not going to go anywhere, broker opinion of values, and they're just not going to go anywhere. And you're going to lose the deal to, a competitor of yours. And it's going to happen. I mean, not everybody wants to work with you. Not everybody's going to like you. You just have to accept or not accept no for an answer, and the numbers game. So you make 100 calls, you may get one listing.
100%. Yeah. I mean, your comments about being easy to work with is like, it's funny. Like, I think the longer or the more time you spend in real estate, whether you're a broker, whether you're a principal, whether you're a lender, whatever you are, the simpler the whole business becomes. And it's like you're just doing the same stuff over and over again with people that you enjoy working with. And that's just like water just flows to that, right? And, as a buyer slash seller who's worked with a whole slew of different brokers in different markets of different skill sets and different property types of small, inexperienced brokers that are listing something smaller because they want to get their first deal done. There's some competitive reason for them to do so, and X, Y, and Z versus folks who focus on larger listings that are 20, 30-year vets. Like I kind of run the gamut in our business in terms of who we've worked with. And, something I think that you do really well in the deals that we've done together is It reminds me of, I forget, somebody said this on, I think it was like Twitter or something like this. I saw somebody, like a broker tweet this, and I was like, oh, that's a really good way of describing it. And basically, he was saying, like, if you're a broker and you are adding more emotion to a deal than you are removing from it, it's going to be hard for your clients to want to work with you again, right? Like, your job should be to mitigate the emotional volatility of a transaction versus introduce your own emotions into the transaction as well as both the buyer and the sellers. And I was like, that's a really great way to frame that. And I think that's really true. And, it's just a fancier way of saying just being somebody who's easy to work with, who's cool, like, just relaxed and calm and composed and all of that, I think is a massive trait for a broker, especially when the deals start getting bigger and especially as the motions start to go up and down a little bit more. And really the last couple of years where the market's been a little bit more volatile, there's been some more retrades. Like, I think that's a really critical personality trait as a broker. And that's a personality trait of the brokers that I enjoy working with. They're ones that are a little just, we're all relaxed on the phone. We're not, there's no heightened emotions that then magnify either a buyer or a seller's emotions or lenders for that matter in a lot of these deals too. So anyways, I think that's like a good takeaway for a lot of the brokers that are getting into the business now is yeah, you got to do the sales reps, the sales and the marketing reps of like ripping all the cold calls and doing everything you can to build those relationships. But once you actually get a listing and a contract, then the focus has to shift to, obviously I want to execute for my clients, but I also want to be really easy to work with along the way in doing so. And I think that's a great tip for those folks out there because it's
Yeah.
an underrated part, I think, of being a broker. Because I think people have this idea of it's like really, you're aggressive on the phone and you're flashy and it's your hard nosed negotiating. But oftentimes it's just being a cool sounding board throughout the process.
Right. And you're supposed to be an advisor, right? I'm not trying to, I am trying to sell you something, but at the same time, you're a sophisticated investor. So you know kind of what you're getting into. And honestly, my job at that point, once we get the contract, is I'm just trying to get this contract to closing as smoothly as possible for both sides. So you try to keep your emotions out of it as a broker because there are a lot of emotions and there's a lot of egos too. When buyers and sellers, things can get heated in certain situations and you have to be very level headed.
Well, Mark, this has been great. I want to wrap here before we go over time, but where can folks learn more about you? Where can they connect with you and plug anything else that you want to plug here?
Yeah, LinkedIn's great. You can reach me on LinkedIn or just via email. I don't know if you have my email, if you could send it out or
I'll throw it in the
just
show notes for sure. But
perfect.
but
Yeah.
share it here as well, just for folks who are listening to the audio.
Yeah, Mark.Savarese at franklinst.com. So you can reach me anytime by email, LinkedIn, shoot me a message on LinkedIn, or you can reach me on Instagram. But yeah, man, I appreciate you having me on. This was awesome.
Love it, man. Thanks again for the time. Yeah, and I'll throw all those links in the show notes. If you're in Florida, the Tampa area, the St. Pete area, well, I mean, even over into Orlando and between Tampa and Orlando, reach out, introduce yourself to Mark, even if you're not in the market of buying something right now. Great connection for you to have in the sense that you'd rather start building the relationships with the brokers who may be able to bring you deals before you're actually trying to offer on them so that there's some level of familiarity there. I would guess you'd probably agree with that, Mark, in terms of like it's better to know the people who are offering on your deals even before you have a listing. So be sure to reach out if you're active in those markets within Florida. And again, all of that will be in the show notes. But thanks again for the time, man. This has been great.
Of course. Thank you for having me.